Welcome to another episode of the Capital Spotlight podcast. I'm your host, Rob Beardsley. Today I have Nate Lowy with me with Juniper Capital Group. Welcome to the show.
Thanks, Rob. How's it going?
Doing very well. Excited about this exciting show we've got here today.
Yeah, me too. There's a lot going on in the capital markets the last couple months. Very interesting stuff, very excited to discuss it.
Yeah, so today, the focus of today's show is going to be, like you mentioned, capital markets, getting into really the inner workings of everything that's happening, what's in favor, what's out of favor, and maybe some discussions about the future. So to jump in, why don't you give us the backdrop of where we're at today? It's August 2020. Explain the situation from a capital markets perspective.
Yeah, obviously like the rest of the world, things are not as expected in the capital markets. Cash flow has been impacted, properties. While there have been some people who, been able to monetize during COVID, but obviously the first thing is cash flow is impacted greatly on a lot of properties. Primarily the biggest hit ones are retail and hotels. Their businesses went from, not just the down year, some businesses went from 100% revenue to zero, like hotels, which, no business can plan for. No, it's completely unexpected. I was talking with a colleague of mine, in March and April, and we were discussing, what's going on and, how we could have predicted. And, this wasn't like in 2008, Lehman Brothers, where there was a collapse or something, banks collapsing. This was a virus that came from China. Like who could have predicted that? Whichever TV author came up with that plot line, they get some awards for that. Completely unexpected. Nobody saw this coming, but a lot of sectors have held up. Multifamily sectors held up. Obviously people need a place to live before they work. Industrial, with all the online shopping that's been going on, has held up, and office space and self-storage have really held up during these times. And they've been fine during COVID. Some sectors of like I mentioned, industrial, obviously with more online shopping, has actually grown, and even in the multifamily sector, certain unexpected things. Certain multifamily products are actually performing better than before. Certain multifamily projects with government contracts or military concentration that used to be viewed as not diversified, are, because they're backed by the government, are everyone's paying rent over there. And some construction deals which were previously viewed as riskier assets, because they had interest rate reserves built in, have also performed well. So, certain parts are doing better than others, but one thing's for sure is, completely unexpected, how this came about. And, that's kind of where the real estate market stands today, and that's kind of how capital markets are viewing things these days also.
So we got really excited about the topic and we jumped right in, but we forgot to introduce you more about your background, about Juniper Capital Group. Let's go back there and just walk through all that so people have an understanding of where we're coming from.
Yeah. So I run a capital markets group called Juniper Capital Group, based out of New York City. Started about 5 years ago on my own. I worked at a different firm for a couple of years as an analyst. Really learned the numbers, and then developed my own. Started my own company about 5 years ago. Really grew it. From doing a couple deals a year to last year doing about 50 deals, like 300-400 million. This year we were on pace to, beat that strongly, but COVID kind of slowed things down. But now that rates are low, hopefully we'll get back to there and have a great year. We focus on all asset types, multifamily, hospitality, retail, industrial, construction. But obviously what's been very active this year is there's been a lot of multi-trading, and because the banks, as we'll get into it, because the banks are still aggressively lending on multi, it's kind of been the focus of a lot of lenders these days. So
Yeah. I'm sure most of your business is coming from recaps though, or refinances rather than new acquisitions.
it's actually surprisingly, it's kind of 50-50, obviously with the Fed cutting rates, rates are very, very low. So a lot of borrowers are choosing, to swap out rates they got 2-3 years ago at historically low rates today. But a lot of investors are saying, hey, there's a spread because rates are so low, there's a spread between interest rates and cap rates. If we're borrowing in the twos and buying at a 5 cap, there's a lot of spread over there, fixed for 10 years, 12 years. So we're seeing a fair amount of activity on the purchase side also.
Yeah, no, it's very true how, some people might view 100 basis point change in your debt, your cost of debt, that actually results in a huge increase in your spread than your cash on cash. And now all of a sudden assets look cheaper and investors are willing to buy it. Yeah. So another thing that we have on our list is COVID reserves or COVID escrows.
Right.
And initially they were came down really harsh and scary and they were brutal really. And then they've loosened up. So where do you think, where are those reserves today and where are they headed in the future?
Yeah. So right when COVID started, everyone panicked. Nobody knew. I still remember talking to some clients saying the first month that COVID hit, we're not sure we're going to be able to make mortgage payments. But so, the lenders turned around and said the same thing. We don't know where cash flow is going to go for the next year or two. So started out with 18 months of principal and interest, taxes, insurance, taxes because a tax lien would supersede a mortgage lien, insurance to make sure that the property is doing well, and replacement reserves. What was previously an ADLTV, when all was said and done, was, something in the 60s because of all those heavy reserves. Now, obviously, as, the world's starting to come back to normal, lenders have loosened up on it. Some community banks are on lower leverage deals, not even asking for any COVID escrows. Agency is down to anywhere from 6 months of IO to 12 months of P&I, which is a lot more palatable. You're still netting leverage in the mid 70s on those deals. But we've come a long way from the beginning of COVID, where it was just like lenders didn't trust cash flow at all and were escrowing for everything, to now they're kind of, just checking boxes, protecting themselves. And that number is coming down more and more every day.
So where do you think, are we headed to a complete elimination of reserves, or are these reserves here to stay until a vaccine or?
That's a good question. I think, as the government's debating another stimulus package, I think that will lend a lot of confidence towards cash flow. And let's not forget, lenders don't lend to the absolute last dollar. They require 125 cover. And usually on a purchase, there's some IO over there. So even they're underwriting to a 125 cover because of the IO, it's really like a 140, 160 cover. So I think that number goes down and down. I think by year end, COVID reserve is a thing of the past.
Yeah. And so maybe some borrowers are waiting for that even.
Yeah. Some borrowers are waiting for that. Some borrowers, don't want to sit around and wait. Rates are low now, without getting to anyone's political views, who knows what the election will bring. And, they just want to capitalize on it. And let's not forget, a COVID escrow, it's still money in your pocket. It's just there, for, 6 months to a year, you'll get it. But I think also as the government announces another stimulus package, cash flow will be more secure. Borrowers and any asset that's kind of already been impacted, has been impacted. The small area of assets that will continue, that haven't been impacted before, that will be impacted afterwards. There aren't really many of those left. So I think more and more lenders will gain confidence in cash flow and kind of beat those escrows down or into oblivion sometime soon.
So something that's really interesting that I don't think as many people understand or talk about is the way that underwriting standards by lenders have changed and can change to result in a change of proceeds without even changing the LTV, right? I'm a lender. I could lend at 75% LTV, but I was lending maybe 20 million. Now I'm only lending 18 million. And so a borrower might say, well, 75% LTV still, nothing's changed, but lenders are finding ways to pull back, and we are seeing seniors pull back in other ways. So talk about some of the underwriting metrics that are strings that the lenders can pull to keep themselves protected or, reduce proceeds.
Yeah. So aside from the COVID escrows is really the main one they're doing, but it impacts itself in a couple ways. So although, like you said, they're saying 75, but after COVID escrows, they're really down to 70. The sponsor has to come up with that extra 5% of equity in the deal. So the borrower has more skin in the game than ever. That's one thing that lenders like about it. It's not just that they're protecting cash flow. They're also kind of making the sponsors come in with more equity. The other thing is, we're seeing that certain markets, lenders, in order to, obviously you underwrite a 5 or 10-year loan, and you underwrite where cash flow is going to go, and that kind of really outlines how much IO you could give. Typically you underwrite 2-3% annual rent growth and 1-2% in expense growth. A lot of lenders are saying, hey, we're cutting back on the expense growth or on the income growth, and kind of flattening that out. In certain markets, they're going the exact opposite. I mean, some properties in Georgia. I have a client who just hit his best month of collections in Georgia. So, some lenders are kind of projecting not as a glorious future, but in certain markets. But then again, like if you go to the industrial markets, they're projecting higher growth than ever. They're the demand, the need for industrial will be higher going forward. So that's kind of the real main underwriting metrics that have changed.
So going to you mentioned the exit test and how that determines IO, and so to explain the exit test more for people. And then one thing I'm curious about is if you have insight as to whether or not lenders have changed the way they're underwriting cap rates in their exit tests.
Yeah. So an exit test is, let's say a lender does a loan for a 10-year term loan. They want to underwrite where the loan will be when where the property will be when the loan matures. So, they take out their Excel spreadsheets. Like I said, they underwrite 3% growth. On the income side, 2% on the expense side. So obviously properties with the lower expense ratio are benefiting more because, as you go farther into the loan, your NOI is growing. Properties with higher expense ratios, above 50%, your NOI is chopping down as you get older. But the general sentiment is, in a couple of years, the world will come back to normal. So, they're not kind of drastically changing cap rates from where they were previously. They expect over the next 5-10 years for the world to kind of level out to where it's been the last couple of years. But the exit cap rates really haven't widened that much because of the long-term play. But it's more so, the income growth that they're kind of, slowing down on in certain markets. But again, in some markets, they're raising them more than ever. So it's really case by case specific. Right.
Generally speaking, I think, this exogenous shock of COVID is more of an income shock rather than a valuation shock. If anything, we've seen a reduction in risk-free rates. And so we've actually seen on the valuation side, things get more aggressive, right? Higher valuations, while the income is maybe a little less dependable, maybe, weakened a bit. So it's almost balancing itself out when we're not really seeing discounts, at least in the multifamily side. I know, of course, there's a different story in hospitality, retail, and depending on where you are in the country, but it's just, if you've got dependable cash flow, it's pretty a stable valuation market.
Right. Yeah. And to further your point, I mean, how hot multifamily is. I mean, tenants have more money now than ever between stimulus checks and, their expenses have gone down, a lot of them because they're not traveling, they're not commuting to work. So, tenants have more money now than, and unemployment, some tenants are making more money unemployed than employed. Some tenants are are richer now than they've ever been on the multifamily side. So, you know, that's that product remains super, super hot, like you said.
So let's talk about the bridge loan market. I think that was one of the markets on the capital market side that was most affected negatively. The dislocation. I know CMBS also took a hit. The CLO space. So talk about bridge loans first, and then we can get into more of the secondary side of that equation.
Yeah. So CLOs was pre-2008 was viewed as one of the market killers. They were very high risk loans, but CLOs 2.0, as I like to call them, were a lot safer. They wouldn't do loans that didn't have cash flow. So, it's viewed as somewhat riskier than your regular stable cash flow deals, but it's a lot safer than it was, pre-2008. Ultimately, that market is kind of, because it's for transitional assets. You're underwriting, you're looking for a value add play or something like that. It's just viewed as risky because, again, people are nervous about where their future is. It's viewed as risky, so the liquidity in that market's kind of dried up. What we've seen some lenders do is they take some of their existing CLO pools. If a loan pays off, they'll throw a new loan into it. But that market's it was one of the first to slow down when COVID hit. But they're expecting it to come back up. They're expecting it to in September to try to do a new offering, see how the market perceives it. But again, the CLOs kind of got a bad rap because of the last go around, but they were much safer this time. In place cash flow, you need a 5 debt yield. They're starting to come back. We're starting to hear murmuring of it. Hey, if you have any, banks are telling us, if you have any CLO eligible deals, let us take a look at it. Let us see if we could get it in. It's definitely headed in the right direction. And CMBS lenders as well. Some of them were hit hard, but a lot of them, these pools are diversified for a reason. There's probably there was a lot of forbearance requests, but a lot of the loans were able to kind of muscle through the tough times, do some workouts, flip amortization to IO, or get a couple months of forbearance, and then kind of figure things out. But for the most part, the investors on the CMBS side, because they were diversified pools, a lot of them made it out okay. And now there's a lot of guys who didn't put out capital at the beginning of the year. They still have to earn some income this year. They're going to be looking at the end of the third quarter, beginning of the fourth quarter, which is actually where we are now, to get some deals done, so they can put their money to good use.
Right. So what you're hearing is that September is that magical month when CLO lenders, bridge lenders are going to start coming back full force in the market.
Yeah, and that will also flexibility will create more opportunity. I think it'll actually help some of the CMBS lenders who have loans that aren't performing. Give it to a new buyer who will have some flexibility to add value and monetize that once he does with a floating rate deal. I think it'll be a good thing for the market to have some CLO loans in there to help stabilize, give people a little bit of time to get things in order. I think it's good for the market, for the CLOs to come back.
And how are terms and pricing changed or going to change for those types of transitional loans?
That's a good question. That's a good question. I'd imagine, they'll kind of dip their foot into the water, hold up a little bit on leverage, a little bit bigger interest reserves. And then as, a couple of them perform, a couple of them close, we might see an uptick in leverage, cheaper rates. But, at the beginning, people are going to be dipping their toes into the water and, kind of walk before you run.
Going back to the earlier discussion about kind of just the general shock in the market. So, pre-COVID, we were all talking about, we're in the 9th inning, we're really late cycle, we need to be careful. There's all these ideas about being at the top of a cycle, and then this happened, and then everybody's expecting or assuming that now this is going to cause a reset in the cycle, and we're going to roll over and then start a new cycle. And I actually just read this morning Howard Marks, Oak Tree Capital, his memo today, and he's saying that just because COVID happened, this isn't a, like you said, a Lehman Brothers 2008 event where, we built up and valuations went too high and we were over levered and then we crash. I mean, this is just an income shock that is bottom up rather than top down from a systemic perspective. So it's a really interesting concept to think that, this doesn't necessarily mean a reset for our cycle and all of a sudden we're going to have, low prices and kind of start anew. So what are your thoughts on that?
Yeah, I very much believe in that. Look, we had the longest bull cycle, I think, of all time, if I'm not mistaken. Things were going right. There were no underlying issues. And especially on the banking side, the banks did it right this time around. They weren't kind of getting aggressive on mortgage-backed securities, throwing defaults into weird categories. For the most part, and obviously, it's a loaded comment, but for the most part, we kind of did things right this time around. We lent on in-place cash flow. Banks underwrote to actual income, not future income. On the community bank side, there was, banks were doing stress rates a lot earlier in the cycle than they did last time around. We were doing fine until, like I said before, a virus came from China that totally was unexpected, and no business, no economy is built to completely shut down. So, to say that there'll be no effects from, 6 months of complete closure, 3 to 6 months, it's tough to say. But the model we had for this bull run, seemed to have worked. And I think it's something that will continue to go around. And as you said, multifamily prices have not gone down. People are hanging tight. Markets that were 90 a door are not all of a sudden 30 a door. They're staying there, if not more. So I very much agree with that. That hey, we did it right this last time. This time around, and as soon as the world resumes, we should be back to where we were very shortly after. It's not going to be a cliff like it was last time.
Yeah, well, let's definitely hope so. So you mentioned about lending on in-place cash flow, or at least if you're lending on a transitional deal, you're subject to like a 5% debt yield, for example, which is pretty strong. Where does a borrower turn if they have a deal that has only a 2% debt yield going in, or just it's a really distressed or opportunistic opportunity?
Yeah, that's a good question. Pre-COVID, there were the hard money space was also very, very cheap. The hard money lenders were leveraging up on the back end, securitizing their loans. Loans that at the beginning of the cycle were 10% interest rate. At the end, last year we're down to 7%. And obviously they bought accordingly. If they were going to have an interest reserve, they had that baked into their price. That market obviously shut down also during COVID and is also expected to pick up in September. But, there's still, high net worths willing to lend money to those kind of transitional assets that are, 20, 30% occupied, sub, negative cash flow. But they want to be rewarded for that. And those are baked into the prices. So that's where it's been, the last couple months. And, we expect liquidity to pick up in that market as well come September.
Where do you think the biggest gap in the capital markets exists? Is it, some sort of senior loan type of product, or is it somewhere in the pref mezz space, asset class based?
The biggest gap, I think right now construction lending, ground up construction has kind of halted, or lenders are cutting back a lot. I think now's the time to make construction loans because, you could get your work done over the next 2-3 years. You don't have to worry about cash flow because that's the nature of a construction loan. And you could probably get a little bit of a higher return than you would have in the past. But, the one, kind of to remember the last cycle and, bring it in is there was maybe a month or two where there were certain assets that couldn't get any mortgages. since then, call it May, June, every asset was able to get a mortgage, was able to get financing. Maybe not at the leverage that the borrowers wanted, maybe not at the terms the borrowers wanted, but there was very strong liquidity for a downturn in the capital markets. A lot of it does have to do with the stimulus packages the government issued, but I think it was very important that there was liquidity for loans coming due, again, with structure and not necessarily terms that borrowers wanted, but even in the eye of the storm, there was liquidity for basically every asset.
That's extremely unique for a downturn, right? Most downturns, that's exactly the opposite. And that's what exacerbates the downturn, is that lack of liquidity. And so just another reason why this is so enigmatic, right? And one of our notes here that we have is talking about the future outlook and talking about, comparing it to 2008 when we had an overhaul of the banking system, and you mentioned Dodd-Frank. So talk about just a little, let's wrap up a little more with kind of a future outlook along those lines.
Yeah, I think I think the future is we go back to where we were. I don't think we need any banking repeal. I don't think we need more checks and balances. I think, as a matter of fact, we might use this to repeal more of Dodd-Frank because they put in their checks and balances and we were fine. We survived. Most of the capital markets survived these really, really tough times, and they were tougher than we could have ever expected. I mean, a complete shutdown for 3 months. Nobody could have foreseen that, and most of the capital markets were fine. The community banks had a lot of liquidity. They had a lot of deposits on hand. Agency who lent to multifamily performed well. I think multifamily, time and time again, always proves out to be the strongest of the food groups. And I think we might even see more aggressive lending on the next go around. A lot of lenders will say, well, we kind of got hit by this and we're still standing today. Let's continue this going forward. I expect, but like I said, I think the fourth quarter is when a lot of lenders and a lot of capital providers are going to realize that, hey, we spent the first kind of 3 quarters of the year playing defense. We got to book some profits over here. Let's play some offense. I think you're going to be seeing some really exciting deals coming to market, being marketed and broadcasted over the next, call it 3 to 6 months of deals that closed. I mean, I just know right now from what we have in the pipeline, we're getting agency deals in the 2s fixed for 10 years with IO. We're seeing CMBS loans for low leverage industrial deals. They're getting aggressive terms as well. Rates are going to stay low, and I think values are going to continue to go up because of that. When, like I said at the beginning of the call, when interest rates are lower, there's more spread over there. Buyers will start getting more aggressive. So I think that fourth quarter is going to be exciting. For fourth quarter, will hopefully make a lot of people forget about the first 3. And I think 2021, the beginning, will also be very, very exciting. I think there's a bright future for the capital markets.
Good deal. Well, that's a great note to end it on. Nate, really appreciate your time. Let all the listeners know the best way to learn more about you and to get in touch.
Yeah, you're welcome to visit us on our website, junipercapitalgrp.com, or you can reach out to me directly, Nate at junipercapitalgrp.com. Lenders are out there. They're looking for loans. They're looking to get deals done. And we're happy to find the right lender for you and negotiate the best terms for you.
Great. Again, appreciate you coming on the show.
Thanks for having me.